What if I told you that there's a penny stock trading for just 12 cents? Sitting inside one of the hottest industries in the world right now. Electric vehicles, but almost nobody is paying attention to it. No hype, no mainstream coverage, no viral tweets. And yet something is quietly building behind the scenes that most retail investors are completely missing. Just quiet moves happening behind the scenes. And today we're breaking it down because this is not your typical penny stock story. This is something deeper, something more uncertain, and something that could go either direction very fast. Now here's where things start getting interesting. This isn't just some random small company trying to survive. It's actually an electric vehicle player working across both commercial and passenger segments, trying to carve out a place in a space dominated by giants. Companies like Tesla, Ford, and Rivian are fighting for dominance in the EV market, but this company is not trying to play the same game directly. Instead, it's focusing on a very specific and often ignored segment. That segment is commercial fleets, delivery systems, last-mile logistics, and utility vehicles. And this is where things get interesting because this part of the EV market is growing extremely fast. And most people are not even paying attention to it yet. Think about how many delivery vans you see every single day. Think about logistics companies shifting toward electric fleets. Think about governments pushing for cleaner transport systems. All of that creates massive hidden demand. And the company we're talking about has already started moving in that direction, securing early-stage agreements and positioning itself for fleet-based EV deployment, which in a small company can actually be a game-changer if executed properly. Because in the penny stock world, it's not about size, it's about timing, narrative, and execution, and sometimes just one or two contracts can completely reshape a company's future. Now before we go any further, let's slow down for a second. Because everything you've heard so far is just the setup. The real story actually starts now, and this is where most people start paying attention. Because right now, this stock we are discussing is trading at just 12 cents. Extremely low, extremely volatile, and sitting in a position where even small news can create huge price swings. Low-price stocks like this are dangerous, but they are also the ones that attract the most speculation, because people are not just buying a company, they're buying a possibility. Now let's talk about something very important. The financial situation behind this company is not simple, and this is where things become both interesting and risky at the same time. The company has shown massive percentage-based revenue growth in recent reports, numbers that look extremely aggressive on paper, but at the same time it is still struggling with heavy losses and cash burn. That creates a very unstable mix, because growth without profitability is not enough to sustain long-term confidence in the market. And this is exactly why this stock sits in a high-risk, high-reward category where outcomes are extreme on both sides, either success or continued decline. Now, another important detail is that this company is no longer trading on a major exchange like Nasdaq, and has moved into the OTC market, which changes everything about how the stock behaves. OTC stocks are less regulated, more speculative, and often driven by sentiment rather than fundamentals, which means price action can be extremely unpredictable. But interestingly, this is also the environment where turnaround stories sometimes begin, especially when companies are trying to rebuild trust and reposition themselves. And that brings us to the next important part of the story. Because something has been changing inside this company recently, something that signals a shift in strategy. They have been aggressively cutting costs, restructuring operations, and trying to reduce cash burn in order to extend survival and improve efficiency. These are not small changes, these are survival-level decisions. And they usually indicate that management is trying to stabilize the company before attempting any major expansion again. But despite all of this, investor sentiment is still divided, and uncertainty is extremely high around whether this turnaround attempt will actually work. Some investors believe the company is cleaning itself up for a second chance, while others believe the risks are simply too high and the history cannot be ignored. And honestly, both perspectives make sense because this is not a straightforward investment case. It is a very complex and uncertain situation. Now, at this point in the video, we have set the stage, we understand the industry, we understand the risks, and we understand the uncertainty, but we still haven't answered the most important question. What is the actual company behind all of this, and why is it getting attention despite all these challenges? Now, let's reveal it. The stock we are talking about is BINI, a company that was formerly known as Mullen Automotive, and later rebranded into Bollinger Innovations in 2025 as part of its attempt to completely reshape its identity. This rebranding is not just a name change, it represents an attempt to reset the narrative, move away from past struggles, and reintroduce itself into the EV market with a different strategy. But even with this new identity, the challenges remain the same: high losses, high volatility, and a very uncertain path forward. And yet, despite all of this, the stock still attracts attention because it is sitting at such a low price point where even small improvements can lead to large percentage moves. Because in penny stocks, perception often moves faster than reality, and sentiment can shift in a matter of days or even hours. Now let's go deeper into the numbers, because this is where the story becomes even more complicated. The company has reported extremely high percentage-based revenue growth, which on the surface looks impressive, but the base numbers are still relatively small and losses remain significant. This creates a situation where growth exists, but stability does not, and that is one of the biggest challenges for companies in early-stage transformation. At the same time, the company is trying to secure more contracts, especially in the logistics and fleet segment, which could provide a more stable revenue base if successful. And this is why some investors are still watching closely. Because if execution improves, even slightly, the stock could react very aggressively due to its low valuation. Now, another key factor is the involvement of activist investors, who have reportedly taken interest in the company and pushed for operational changes and restructuring. When activist investors step in, it often signals that someone sees hidden value or potential that the broader market is ignoring. But it also adds pressure on the company to deliver results faster because expectations increase immediately. So where does all of this leave us? We are looking at a company in a high-growth industry, trying to survive financial pressure while attempting a full identity and operational transformation. It could either stabilize and slowly rebuild trust, or it could continue struggling under debt, losses, and volatility. And that is exactly what makes this type of stock so controversial, because outcomes are not predictable. They are binary in nature. Either it works or it doesn't. And that is why investors are watching it so closely, because sometimes the biggest moves in the market come from the most uncertain situations. So the real question is not just whether Beanie is a good investment, but whether it can actually execute its turnaround strategy in time. And that is something only time will answer. If you want more deep breakdowns like this on hidden penny stocks before they move, make sure you subscribe, because the next opportunity might already be forming right now.